Before we begin, it's my pleasure to introduce our speaker for today, Chin Yixuan, with background in economics from University Malaya. Currently, Yixuan is the general manager of Alcopedia Sdn Bhd, which is a proprietary trading firm in Malaysia specializing in algorithmic trading. He has over 5 years of content creation experience on personal finance and investment via his personal blog, nomoneyla.com. Besides that, Yi Xuan is also featured in various media platforms such as City Plus, FM, BFM Caijing, and others. So without further ado, I'm delighted to hand over the presentation to Yi Xuan. So Yi Xuan, there you go.
Good evening, everyone. My name is Yixuan, and let's proceed to the sharing session today. So what we are going to talk about today is the topic is Introduction to Spread Trading with Malaysia Futures Products. Now, before we proceed, a quick disclaimer. This presentation is provided for general information only. It is not intended as an investment advice, offer, or solicitation for the purpose of sale of any securities, stocks, futures, or investment products. Stocks, securities, and futures imply risk and to be undertaken only if you understand the risk. Please seek your own tax, legal, and financial advice before investing in stocks and futures. All information in this presentation is subject to change without notice. Now, what are we going to talk about today? First of all, we are going to talk about spread trading. I'm going to introduce spread trading to everyone and why a trader should consider trading spread. And secondly, we are going into more practical application of spread trading. I'm going to share with everyone how to formulate a spread trading strategy or idea. And number three, I'm going to share with everyone what is the downside or risk of spread trading. And lastly, and for those of you who are new, I'm going to share with you how to get started with spread trading. Now, before we proceed with spread trading as a whole, I want to ask everyone that's sitting in today, any one of you have traded futures before? If yes, type 1 in the comment section below. If you have not traded futures before, type 2 at the comment section and perhaps let me know what other instruments do you trade aside from futures. Right, so I see a balance of audience. Some of you have traded futures before, some of you have not traded futures before. So don't worry, for the sake of everyone, I will share the basic of futures as a trading instrument, because what I'm going to share here will relate to the important session that I'm going to share later. So what is futures essentially? Essentially, futures represents an agreement to buy or sell an asset at a future date at an agreed upon price. So when you trade futures, right, you get a lot of access to various products, such as energy products like crude oil or natural gas, metal products like gold, silver, and copper. You also get access to market like commodities products like soybean, corn, wheat, and our very own crude palm oil. And not only that, you also get access to stock indices like the S&P 500, the NASDAQ, the Dow Jones, and even our very own FKLI index. Now, what makes futures so special compared to the likes of maybe trading stocks or Forex, as in this case, right, is this thing called contract month. A unique feature of future trading is that the trader have the ability to trade futures contract with different expiration month. So, for example, right now, you can, for traders, you can trade the July crude palm oil contract. At the same time, you can also trade the August and September crude palm oil contract. So, just a quick segue. For crude palm oil, I'm going to use the short form of crude palm oil futures contract, which is FCPO. Okay, so I'm going to use this interchangeably. Okay, so coming back, so as a trader, you can, in the futures market, you can trade not only the July 2024 FCPO contract, you can also choose, if you want, to trade the August 2024 and September 2024 futures contract. So And not when it comes to, because there are different contract month in futures, so we have a different term for it. So for contract month that's nearest to us, we call them the near month contract. Okay, for the contract months that are further from us, we call them the far month contract. Okay, so as an example, right, for us right now, since it's July, so July would be a near month contract for us, and months like August and September would be far month contract. All right. Now, because of this very special phenomenon in the futures market where you get to trade contract with different expiration month, you have a very special phenomenon that you can see in the futures market. The first price phenomenon is what we call contango. Contango is where the price of far month futures contract, as an example, September, right, are higher than near month futures contract like July. So as you can see on the first row of the visual that I'm sharing with you, okay, the price for August 2024, sorry, let's start with the price of July 2024 first, is 4,000 ringgit, followed by August 2024, 4,050 ringgit, and September 2024, 4,100 ringgit. So we can see the price is rising across the expiration month. So this is what we call contango. Now, the next phenomenon that we can see in the futures market is called backwardation. So backwardation is essentially the terbalik, right, of contango. It occurs when the far month futures contract, in this case September or August, are lower than the near month futures contract, which is in this case July. So as you can see in the second row of the visual, okay, for July 2024, the price is 4,000 ringgit. But this time, for August and September 2024, the price is 3,950 and 3,900 respectively. So you can see the price is going in the downtrend. So this is what we call backwardation. Now, at this point, I want to test everyone, just a quick test or quiz, so I know that you understand where I'm going. All right. So right now, in this slide, you see two pictures. First of all is July 2024 at 4,500 ringgit and August 2024 at 4,550 ringgit. So is the price for far month? Okay, so my question is this a contango or backwardation, ladies and gentlemen? All right, I see a lot of answers coming in. Yes, it's correct. It's contango. This, for those of you who are just in, so essentially contango is where the price of far month contract is higher than the near month contract. This is what we call contango. Okay, so in this case, the price of August contract is higher than the July contract. Now let's move on to another quiz over here. So imagine in this case, July 2024 is 4,500 ringgit and August 2024 is 4,150 ringgit. So is this a contango or backwardation? All right, I see a lot of answers coming in as well. It is a backwardation. Okay, so backwardation is essentially where the price of August contract, in this case, the far month contract, is lower than the July contract, which is the near month contract. Okay, to show you in a visual manner, okay, what contango and backwardation is, right? Take a look at this chart over here. Is what we call this the forward curve, where it shows you the price difference between different contract months. Okay, so in this case, you take a look. I want to divert attention to the green arrow first. The green arrow is what we call contango. Okay, so if you have understood what I've said just now, contango essentially is where the price of far month is higher than the near month. So that's why you see the price is sloping up. Okay, the forward curve is sloping out. Okay, meanwhile, backwardation is represented by the pink color arrow. All right, so what it means essentially for backwardation is you can see the price of futures for far month contract is lower than near month contract. That's why you see that the arrow is pointing downward, is sloping down. Okay, now some of you at this point might have the question, okay, where do I get this forward curve? Okay, it's very simple. You can try it out yourself. I'll show you how to get it. So I think most of you are familiar with your chart, the charting platform called TradingView. Most of you who invest know what is TradingView, right? So essentially, if you want to find the forward curve of a futures product, simply go to futures chart on TradingView. In this case, I'm typing FCPO. FCPO represents crude palm oil futures. Okay. Now, once you type FCPO, then on your right, follow my on the top right corner of the screen or the slide over here. Click on the menu or watch list chart icon. Then you scroll down. You'll be able to see the forward curve of a particular futures product. So in this case, we are looking at the forward curve of a FCPO or crude palm oil futures. Okay, so then you can explore for yourself the difference in contango and backwardation nature of a futures product. Okay, so just a quick wrap up or summary of this particular section. So first of all, for those of you who are totally new to futures, futures represent an agreement to buy or sell an asset at a future date and then agreed upon price. A unique feature of futures trading is you can, at least compared to the likes of stocks, is that futures traders have the ability to trade futures contract with different expiration month, just like how I showed you just now. You can trade July, you can trade August, you can trade September. Okay, so the contract that is nearest to us we call them the near month contract. The contract that is further from us, we call them the far month contract. Contango, there are two price phenomenon in the futures market. Contango is where the price of far month is higher than the near month contract. The next phenomenon that you can see is a total opposite. We call them backwardation, is where the price of far month contract is lower than the near month contract. Now, the reason why I cover some of the basics of futures just now is because if you relate to spread trading, and we will go directly into this. Now, before that, a question to everyone. Have anyone traded spread before? If you have traded spread before, type 1. If you have not, type 2. Okay, so I see a mix of reaction over here. So generally, I would say majority of the people here have not traded spread before, and which is okay. I'm going to cover the very basic of spread trading. Okay, now, so essentially, what is spread in the futures market? Spread essentially, don't overcomplicate things, right? Spread is just a price difference between two futures contract. Okay. So from technical point of view, when the trader say he or she trades spread, the trader essentially he or she is doing is just buy 1 month future contract and sell another month of future contract at the same time. So in this case, if you can see look at the picture over here, when we say we are trading spread, we are essentially buying the July 2024 FCPO contract and selling the August 2024 FCPO contract. So let's do a quick example, right? So let's say here is the July 2024 contract is 4,000 ringgit and the August 2024 contract is 3,960 ringgit. So my question to everyone here, what is the spread? What is the spread for July and August? Yes, the spread is 40 points. Yes, all right. Simple, right? Okay, nothing too complicated here. Now, let's try another one. If the price of FCPO for July 2024 becomes 4,100 ringgit, what is the spread right now? The spread becomes 140 points. Well done. Okay, awesome. Now, final quiz. Okay, so if instead, in this case, July 2024 contract is 3,950 ringgit and the August 2024 contract is 4,050 ringgit, what is the spread for July and August in this case? Right? The answer is minus 100 points. So essentially what I'm trying to share with everyone here is number one, spread is just a price difference between two futures contract, right? Very simple. I'm going to share with you how we traders form trade ideas with this. And number two, what I want to share with everyone is when it comes to spread, it's very normal to see positive and negative spread. So don't be shocked when you look at your spread chart in the future while you are trading spread and you see positive and negative figure. It's very normal in the spread trading while you are doing spread trading. Okay, so I bet that people that trade stocks will be very surprised by the negative figure. But yeah, this is something very interesting. Okay, all right. Now I'm going to show you in this picture what would you see when it comes to your trading platform for outright and spread trading. So on the first row, you will see the crude palm oil contract, the individual crude palm oil contract. So things like August, things like crude palm oil contract for July, August, and September. And the second row, you'll see the crude palm oil contract for spread trading contracts. Okay, so in this case, you'll be able to see the July, August spread, and the next one, you'll be able to see the August and September spread. Now, let me show you let me validate together with you how the spread is being calculated. So in this case, let's use the first example, July and August. So when we want to calculate spread, remember, we always buy 1 month and sell another month. Essentially, we buy July and sell August in this case. So my question to everyone, what is the spread for July and August based on the price that you are seeing right now in the screen? The answer is 44. So with that, right, we have validated that through this trading platform screenshot, we have validated that it's just calendar spread. Spread is essentially just the price difference between two contract of different expiration month. Now let's use another example. In this case, August and September. What is the spread for August and September? Anyone? The answer is, yes, the answer is 16. So as you can see, it's actually very simple. It's nothing too crazy or it's nothing too complicated. Okay, but I know that by showing some of you guys number, it might still not make a lot of sense, but let me show you visually how it works. Okay, so as you with the chart over here, what you are seeing essentially is the two price chart for crude palm oil futures that with different expiration month. So the blue one represent FCPO for July contract. The orange line or price chart represents FCPO for August contract. So as you can see, if you observe closely, they essentially move almost the same, right? When one contract goes up, the other goes up as well. But if you notice closely, there's always a gap between them, right? No matter how small, there's always a gap between them. And ladies and gentlemen, this is essentially what we call the difference between all the blue line and orange line is what we call spread. Okay, this is spread. All right. Okay, now that we have learned the basic of spread, let's go more in depth into spread trading. Okay, spread trading. What is spread trading? Essentially, right, when it comes to trading spread, what us spread traders we are looking is essentially two things. At its simplest form, spread trading refers to traders speculating on the price difference between two futures contracts of different months. Okay, so this is also known as calendar spread. So there are many forms of spread trading in the trading world. Okay, so what I'm going to share with you or what I'm going to discuss today is the most basic version of spread. We call it calendar spread. So basically 1 month minus another month, 1 month minus another month. Okay, there are many other more complex spread in the market. Is something like butterfly spread. There are also inter or intra commodity spread. So nevertheless, let me just cover the basic here today. All right. Now, when a spread trader is being bullish, okay, when a spread trader is being bullish on the spread, what we are looking for essentially is the widening of a calendar spread. Let me show you what I mean by this. So, as an example, let's say today the price of FCPO August 2024 is 4,000, and the price of September 2024 FCPO contract is 3,950 ringgit. The spread is 50 points. Now, once I take a if I'm bullish on this, and next week the FCPO price for August become 4,100 ringgit, and meanwhile the FCPO price for September 2024 becomes 3,960 ringgit. So the August and September spread becomes 140 points. Okay, now today 50 points, next week 140 points. So my question to everyone, has the spread widened or narrowed? Has the spread widened or narrowed? Okay, I see a lot of answers here. Thank you, everyone. So yes, the answer is correct. The spread in this example, the spread has widened, right, from 50 points to 140 points. So this is essentially what we are trading, okay? Now, let's look at the other side of story. When spread trader says he or she is being bearish on the spread, we are basically looking for the spread to become more narrow with time. So in this case, let's say today, the spread is 50 points, okay? Next week, the spread, the August 2024 contract is 4,100 ringgit, and September 2024 contract is 4,080 ringgit. So right now, the spread becomes 20 points. Okay, ladies and gentlemen, what has the spread become in this at this point? Widened or narrowed? All right, narrow, right? So this is correct, everyone. Thanks for the response. Okay, keep coming with all the response which I'm going to share, going to ask all of you later. Okay, so essentially in this case, when we are being bearish with a spread, we are essentially looking for the spread to narrow with time. Okay, now for those of you who are very familiar with what we call directional trading or outright trading, basically buy low, sell high, right, and so on. So, as an investor, as a trader, I think most of you know what is outright trading. So what I want to show you is the difference between outright trading and spread trading. Essentially, the difference in definition between of bullish and bearish definition between outright trading and spread trading. Okay, now for outright trading, when you are bullish in outright trading, you're essentially betting or speculating that the price will increase with time, right? Makes sense? You buy low, sell high. Okay, when you are bearish, when it comes to outright trading, you're essentially speculating that the price will go down with time. Make sense? Okay, I think this would make sense for a lot of us because especially if you are very familiar with investing and trading. But on the other hand, for spread trading, when we say we are being bullish, right, we are not actually really looking at the direction of the individual contract, futures contract. Instead, we are looking for the spread to widen. So in this case, if you look at this chart, right, it doesn't matter if the price, whether the direction of price is not the most important thing. The most important thing is that with time, the price difference, right? Remember the keyword here, the price difference between both contracts widen with time. Okay. Now, when we say bearish, right? When we say bearish, we do not. Again, the direction of the price doesn't matter. It's more on the price. Sorry, it's more on the price difference that matter. So in this case, when we are spread trader is being bearish, essentially we are looking for the spread to become more narrow with time. Okay, so if you take a look at this particular chart on the right, the price of both contracts increase, but we are, as a spread trader, we still make money. Why? Because again, let me repeat, this is very important. It does not depend on the direction of the individual contract. What matters is the price difference, right, between each spread contract. Make sense? Okay, so I hope this particular visual comparison will help you, give you a better understanding between what is being bullish or bearish mean in outright trading and spread trading respectively. Okay. Now, to summarize what we have learned so far, okay, I want to divert everyone's attention on the green side of the table. When you are buying a calendar spread, what you are doing is you are essentially being a bullish trader in this case. And you make money when the spread widens. Okay, when the spread widens, you make money. When you lose money, on the other hand, is when the spread narrows, right? You are betting on the spread to become wider with time, but when the spread narrows, this is where you lose money. Okay, understand? Now, on the other hand, when you're selling a calendar spread, essentially you are betting, you are being bearish with the spread, and you make money when the spread narrows, and you lose money, easy, right? You lose money when the spread widens. Now, let me show you a quick P&L calculation, how to calculate a P&L for spread trading. Okay, so let's say today the price of FCPO August 2024 is 4,000 and FCPO September 2024 is 3,950. So the spread over here is 50 points. Okay, next week, FCPO August 2024 is 4,100 ringgit and FCPO September 2024 is 3,960 ringgit. Okay, in this case, the spread has become 140 points. Okay, so if we are bullish, ladies and gentlemen, if you are bullish with this spread, how many points have you made in terms of profit? How many points have you made? In terms of points, just in terms of points. So yes, correct. 140 points minus 50 points, you get 90 points. So your profit is 90 points. Let's say, okay, the value per point for FCPO contract is 25 ringgit. Okay, what is in terms of RM? All right, in terms of RM, how much have you made? How much have you made in terms of RM? So remember, we made 90 points from this trade, but in terms of RM, how much did you make? Anyone? Yes, correct. Thank you. So in order to calculate your profit and loss, in this case, profit, right? What you need to do essentially is you got to take the profit in points, in this case, 90 points times by the value per point of the underlying futures product. In this case, for FCPO, the value per point is 25 ringgit. So your profit, total profit in this trade is 2,250 ringgit. Okay. Now that we have covered spread, the basics of anatomy of spreads, right? We gotta cover why trade spread. Some of you might be wondering why if you walk into some of the professional traders, futures traders, you ask them what do you trade, some of them will tell you they trade spread, right? Let me answer the question of why some traders, at least why some top professional traders decide to trade spread. Okay, first of all, it's the lower margin requirement. Spread trading requires lower margin requirement. So why? Because calendar spread, they tend to have lower volatility than outright contract. As such, generally, calendar spread has a lower margin requirement relative to an outright contract. So let me show you a screenshot here. This is the crude palm oil futures contract for September and October. So if you see the yellow highlighted area, this is the margin requirement to initiate a trade in either September or October, respectively. So initial margin, for those of you who are not familiar with future, means that the amount required, the initial amount required by a trader to open a trade, just to open a trade, right? So in order to open a trade for September 2024, you need an initial margin of 7,000 ringgit in your account, okay? And maintenance margin essentially means that the amount that the trader must keep in his or her account if he want to keep holding the trade, maybe for a few days or a few weeks or months, okay? Now, on the other hand, right, so basically what I'm trying to share with everyone here is that if you want to trade a futures contract, individual futures contract like September or October, okay, you need quite a bit of capital just to trade one contract. But on the other hand, what if you trade the September-October calendar spread? Okay, if you trade the September-October calendar spread in this screenshot, is taken at the same time. Okay, all these three screenshots, you only need 1,300 ringgit of margin. So imagine it's much more capital friendly, especially for traders with a smaller capital size. Okay, so as such, this is one of the reasons why so many traders decided to trade spread, because it's very margin friendly. Okay, it's easy to get started, especially if you have a small account. Now, the second benefit is that there's very clear seasonal pattern especially in some of the underlying futures instrument for their spread. Okay, they tend to display a very consistent seasonal pattern. So as an example, I will show you this. I'm going to explain more later. Okay, but for now, just focus on how consistent the spread seasonal pattern is. So example, FCPO spread tend to narrow in May. So as you can see over here in the screenshot, represents the June and July calendar spread from 2022 to 2024 for 3 years. So for all 3 years, if you take a look, right, in the month of May, the spread tends to be bearish. In other words, the spread tends to become narrow. So this shows you that there's actually, for those of you who are familiar with trading, you already have a hint of how you can trade spread, right? Okay, but don't worry, I'll show you more details later. Okay, so this is another benefit of trading spread, clear seasonal pattern. So a quick takeaway from what we have learned so far, why trade spread? Number one, calendar spread has a lower margin requirement than trading outright futures contract. That's why it's more capital friendly for traders with a smaller capital. Okay. Now, for another benefit of trading spread is for some instruments, their calendar spread tend to display a very consistent seasonal pattern. Of course, it's not always 100%, but it's very reliable. Okay. Now, we have come to I would say, the most important section of this whole presentation. Okay, how to form spread trading ideas with Bursa Malaysia derivative futures product. Now, just a quick introduction. Do you know that in Malaysia, our very own Bursa Malaysia derivative product, there are a lot of very vibrant products. Okay, let me just show you some of them. Okay, first of all, I've talked about this a lot today, is the crude palm oil futures product. And we also have the soybean oil futures. Not only that, we also have equities futures like the FKLI futures, F4GM futures, and FM70 futures. We also have precious metal like gold futures. And not only that, we have also this year, we are also able to trade the USD and China renminbi FCNH futures. So imagine from commodities to equity indices to precious metal to even currencies. There are so many products that you can choose to trade when it comes to futures market in Malaysia. Okay, pretty interesting, right? Now, with that in mind, how can you form trade ideas with spread trading? For those of you who pay attention in the previous section, you know, okay, for the first thing that we can use, first technique that we can use to form trade ideas is what I call seasonal and fundamental analysis. So seasonality represents a repetitive and relatively predictable pattern in the market, while fundamentals involve factors like inventory level, weather, production, and consumption. Now, when we combine the knowledge of seasonal pattern and fundamental, it can be very helpful in helping you build a trading edge as a trader. Okay, so especially if you are watching, if you are a trader, then you are a little you are not sure what to do in your trading journey right now. This is the section that you need to pay clear attention to, because I believe after tonight you might not have the full picture yet, but you have a clear direction of where to work on. Okay, especially if you are a trader that's looking for a specific direction in your trading journey right now. Okay, now let me go into more detail. Let's start. I'm going to give you an example of FCPO. All right, let's do a seasonal and fundamental analysis of FCPO. Okay, FCPO is one of the most traded futures contract in Malaysia. And in fact, do you know that Malaysia is the second largest CPO producer in the world? Right, of course, the first being Indonesia right now, but Malaysia is the second. Okay, now in Malaysia, palm oil is produced in states like Sabah, Sarawak, Johor, Pahang, Perak, and Seremban. So if you take a look at this map over here, basically you can see that the majority, okay, of palm oil is produced in states like Pahang, Johor, Sabah, and Sarawak. If you look at the red dots, Okay, this is where you see a lot of palm oil mill where they process all the palm oil. Okay, and this is important. This map is important because it will relate to what we are going to discuss later. So just remember Sabah, Sarawak, Johor, Pahang. Okay, Sabah, Sarawak, Johor, Pahang. Okay, and palm oil production is highly seasonal in Malaysia because in Malaysia there are certain months, right, that is very rainy. We call it rainy season. Okay, and there are certain months that is very dry. Okay, so what does that mean? Okay, so in November and March, okay, now we have come to seasonal analysis, right? Ladies and gentlemen, pay attention, okay? In November and March, in Malaysia, we typically experience this thing called the northeast monsoon, or in Malay, we call it monsoon timur laut, where they tend to be heavy rainfall in palm oil producing states like Johor, Sabah, Sarawak, and Pahang. Okay, so this is where what this means, right? What the impact of this essentially is November and March is since it's seasonally more rainy, right? Production of palm oil usually drop and they usually bottom around February and March. Okay, after that, when the rainy season has subsided, right? What will happen is from April onwards, April or May onwards, right, where there's seasonally less rain, production of palm oil will pick up in April or May, and they will usually peak around October, right? What this means, right, essentially is what is number one. Before that, let me just cover one quick thing first. Okay, we have talked about how spread they tend to widen or narrow over time, but I haven't shared with you some of the reasons why they widen or narrow, why they move that way they do. Okay, one of the reasons why spread they tend to widen or narrow is due to uncertainty. Okay, remember the word uncertainty. Of course, this is just one of the many reasons, but uncertainty is one of the key reasons why, especially when it comes to commodity or trading, they tend to affect or influence the spread. Okay. Now, generally, uncertainty at the present moment will cause near-month contract price to rise more than 5-month contract. Okay, so as an example, let's say initially the price of palm oil, near-month palm oil contract is 4,100 ringgit, and the price of 5-month palm oil is 4,050 ringgit, and the spread over here is 50 points. What if, right, we suddenly experience a rainy season where the rain falls heavily, right? It will cause the palm oil production to drop. And what will happen? Okay, keyword here, there will be higher uncertainty at the present because there are more risks at the present. You don't know what will happen, right, with all the production and everything. So this is where the spread this is where the price of palm oil at the near-month palm oil contract tend to rise in an extent that's larger than the 5-month palm oil contract. Okay, as such, you can see the spread becomes, in this case, the spread becomes 250 points for illustration purpose, right? This shows that the spread has widened. Now, on the other hand, once the uncertainty at the present moment is resolved, okay, near-month price will stabilize against the 5-month contract. So as an example, so let's say the sunny season has come, right? The rain has subsided. So what will happen from, let's say just now, the price of near-month palm oil contract is 4,500 ringgit, and the price of 5-month palm oil contract is 4,250 ringgit, which means a spread of 250 points. So if the rain subsided and everything becomes normal, back to normal, what will happen is, what you'll see generally is the price of near-month contract will drop more than the price of 5-month futures contract. So in this case, if let's say it dropped for near-month contract, it dropped from 4,500 ringgit to 4,300 ringgit. And for 5-month contract, it dropped from 4,250 ringgit to 4,150 ringgit. So both drop, but the near-month drops in the larger extent compared to the 5-month contract. So in this case, the spread actually becomes more narrow with time. Okay, so basically what I'm trying to show you here is that uncertainty will cause the spread to widen While on the other hand, once uncertainty at the present moment is resolved, then the spread tend to becomes more narrow. I'll share with you in practical historical seasonal pattern, how it works, right? So in this slide, so essentially what we have learned so far is that for crude palm oil, the rainy season tend to be until March, February or March. So and starting April, there will be seasonally less rain, and hence production tend to pick up in around the month of April or May. So what's the seasonal tendency here? So when in the month of April or May for crude palm oil, the production tend to recover. Okay, and then when the production recover, right, there's less price premium for near month FCPO contract due to there's less uncertainty already because the weather has become better and production is recovering. Okay, when there's less uncertainty, what will happen is the FCPO spread tend to narrow in May. Okay, in other words, what I'm trying to say here is FCPO spread tend to be seasonally bearish in May. So let me just show you the chart that we have seen in the previous section. So if you can see over here from 2022, 2023, 2024, in the month of May, okay, the spread for June and July calendar spread has consistently been bearish. So this is a very, I would say, a reliable way, unless there are a fluctuation in the fundamentals of the weather and so on. This is a very reliable way to trade spread as a spread trader. Okay, and there's no guesswork in this case, right? If the fundamentals are correct, if the weather and everything is within what we are expecting, then this is something that we can trade on, right, as a spread trader. Okay, now I'm going to show you another example here, which is FKLI, the Kuala Lumpur Composite Index Futures. Okay, so FKLI tracks the FKLCI index, which comprises of the top 30 largest listed companies in Malaysia by market cap. So unlike commodities futures products like the FCPO, which relies a lot on things like inventory, relies on things like weather or production, FKLI as an equity index, right? Their seasonality is partly influenced by the things like dividends. Okay, so as such, what's the seasonal tendency here? Is that you see the price of FKLI contract in February be higher than FKLI futures contract in March. Why? Because March is the time of the year where dividends is announced. That's why you see that for the price of March FKLI contract, dividends are usually factored in their pricing. So essentially what I'm trying to say here is that February tend to be seasonally more bullish, right, for the February and March FKLI calendar spread. Okay, let me show you what I mean, right? Let me show you a chart over here. Okay, so this chart over here, in the price line, the price chart in blue is the FKLI February 2024 contract. The orange line represents the FKLI March 2024 contract. So you can see, right, the price of the orange line, which is represent the March FKLI contract, is consistently lower than the blue line, which is the FKLI February contract. Okay, so if you look at the green highlighted square zone, right, so to say, is the month of February 2024, you can see that the spread is widening over time. So if some of you might at this point might not spot it yet, because I agree, it's not actually not very obvious, but if I show you the spread chart, this is essentially the same thing, it's just a spread, the price difference between February and March. You can see that for the month of February, right, is actually bullish. So the spread is actually widening over time. Okay, so this is also another consistent seasonal pattern that you can see in the FKLI futures. Okay. Now, another way that you can trade spread is through, I think a lot of traders would be very familiar with this, is through pure technical analysis, things like price action, support resistance, right, indicators, and so on. So let me just show you a quick example. As an example, okay, this chart, we are seeing a very clean sideways pattern. So for those of you who are very familiar with support and resistance, right, but if you see such a clean price action, I think it's only rational to trade. It's only rational to trade the resistance and support respectively. Okay, so the third way you can do is combine seasonal fundamental study with technical analysis. So let's do a quick recap. So seasonal fundamental analysis will give you context and directional bias. Technical, on the other hand, will give you a better entry location. So remember just now, recall that FCPO, for the month of May, they tend to be seasonally bearish. So this is from our seasonal and fundamental study. So our bias for the month of May is always to look to go short. If everything, of course, if the fundamentals are correct. Okay, so now that we have gotten the fundamentals right and seasonal study right, now let's look for a good entry. So we from this chart we can see that there's a very clear sideways pattern, and the clean resistance and turn support is formed at 37, the price of 37. Okay, so on the other hand, another piece of technical context that we can get here is prior to May, right? There's already a clear downtrend being formed. Okay, and then so when is the best entry in that you can spot, right? For me, if I were to enter a short in May, then I think the yellow arrow within the month of May would be my best entry, where the price breached below 37, we tested 37, and at the same time, we tested my downtrend, my trend indicator of 21 EMA. So this is, for me, a good entry point. Of course, you use your own technical indicators that you are familiar with. Okay, what I'm trying to say here is you can use you can combine seasonal pattern and fundamental studies alongside technical analysis to make a trade decision, make a better trade decision, so to say. Now, I want to cover quickly the downside of spread trading. The downside of spread trading is because remember, when you're trading spread, you're essentially taking, in this case, right, in this example, you're taking a long buy, you are buying a August 2024 contract and you're selling a September 2024 contract. Okay, so when you're taking a calendar spread trade, you're essentially taking two individual contract trades. Okay, so in other words, you're actually paying 2 times the commission. So what do I mean by this? So essentially, if I'll use a keyword here, is called round turn, which means you are entering and exiting a trade. So let's say the commission is, I'm comparing a 6 ringgit round turn commission and a 5 ringgit round turn commission. So initially, the spread of the commission for one spread contract is 12 and 10 ringgit respectively. The difference is just 2 ringgit. But if you are a very active spread trader, if you are trading until 100 spread contracts per month, the difference that you can save, right, with 1 ringgit of saving in round turn commission would be 200 ringgit. So that's why for spread trader, it's very important that you get the best deal from your broker. Okay. Now, the second downside, I would say, for spread trading, at least right now in the trading community, is there's a lack of information online compared to outright trading that you can easily find on the places like YouTube and Google. Okay, but however, right, if you visit Bursa Academy's website, I noticed that there have been a lot of accumulation of very interesting and insightful futures trading and spread trading related content over the years. So please feel free, if you want to learn more about spread trading, feel free to go to Bursa Academy website. Okay. Now, the other downside I would say for spread trading is they are generally lower liquidity. Okay. So I want to show you what I mean by this. So on the first row, you are seeing the individual contract volume for July, August, and September. On the other hand, at the bottom row, you are seeing the volume for calendar spread for July, August, and August, September. As such, right, you can see visually from the difference in volume, right? Generally, the volume is lower when it comes to trading spread, at least compared to outright trading. Okay. So some of you might be wondering how to get started with spread trading. Okay. First of all, I think personally, I would say the best, all-in-one place to learn about, especially futures and spread trading, is Bursa. right? You in Bursa, you can learn things like fundamental, seasonal, and technical analysis. There are so many webinars that's being recorded over the years. You can just find a lot of nuggets, golden nuggets about trading in Bursa website. All right. And next, after learning all these things, I would suggest you to look for brokers that offer spread trading. So if you are interested about which which futures broker are there, you can again go to Bursa website and in this case, Bursa Marketplace, and click on open a trading account. Then you'll be directed to a list of futures broker that's available in Malaysia right now. All right. Now, while you are doing so, I would recommend that you, because unlike stockbrokers in Malaysia, right, futures broker in Malaysia, they don't publish, most of them at least don't publish their commission rate. So what you need to do is you gotta email them, ask them, hey, what's your commission, right? Give me the best deal. So you gotta reach out to them, ask them for their commission. So commission rate. That's why I implore all of you, if you are interested in trading futures, you want to open an account, go shop around, right? Ask for the best rate for yourself, okay? Now, of course, you want to choose a broker that give you access to assets that you want to trade, like palm oil, FKLI, and even new products like the FSOI and also the FCNH product. So you can ask them if they allow you to trade all these assets or not. Okay, so I would even add on to say that you want to choose a broker that offers you a very good support, because futures product you can trade at night as well, right? It's not just the morning, so you can trade at night as well. So you want to support that you can reach out to 24/7. At least at night you can also reach out to them, right? You also want to have a broker that offer you platform that you can do your charting and shows you the price ladder as well. Okay. Now, some of you might have questions after our discussion today, how to find a spread chart. Okay, let me show you quickly how to find a spread chart. Now, before that, you gotta understand one thing. In futures, for the month of January until December, they use an alphabet to represent different months, right? It's just what it is, okay? So example, for the month of January, you have the contract month, the contract alphabet is F. February is G, and so on, okay? You can see on the list, on the table on the left over here. So how to find a spread chart in this case? So I'm going to use the most, I would say, commonly used charting platform, TradingView. If you are interested, you can try it out for yourself. Go to TradingView, right? Key in the ticker and contract month and year, minus the ticker, contract month, and year for the subsequent contract, and hit enter. So in this case, what I'm showing you here is the FCPO for, if you see FCPO Q 2024 minus FCPO U 2024. So Q essentially is the month of, what's the month for Q? Anyone? What's the month for Q? Yes, the month of Q is August. The month of U is September. So I'm looking for the spread chart between FCPO August 2024 and FCPO September 2024. You can try it out for yourself in TradingView. And once you hit enter, you'll be able to see the chart. Okay. Now, personally, I would say if you look at this chart, it can get very dizzy because you look at all the candles, right? So personally, what would I do normally is I will go to the candle selection. I'll choose area instead of candles. So when I choose area, you get a clearer view of the overall trend of the calendar spread. All right, makes sense? So go try it out yourself after the webinar. All right, it'll be pretty interesting. Now, then, another way you can get a spread chart is through your trading platform. In Malaysia, most futures broker offer this platform called Quick Screen Trading, or QST. So essentially, just type, they use a different symbol in the QST platform for FCPO. It's called MPC. So same thing, MPC, August 2024, Q24, and U24. And when you hit OK, you get the calendar spread chart. Okay. So, but for those of you who do not have a broker yet, don't worry, go try the TradingView method that I showed all of you just now. Okay. Okay. Last question. Last thing that I want to address: how much do you need in capital to get started with spread trading? Okay. to answer this question, let me show you, first of all, step one, identify the margin requirement for the calendar spread that you want to trade. So margin, again, as a reminder, essentially is the amount you need in your account to initiate and hold your trade. So in this case, the margin is required to trade this MPC or crude palm oil August and September contract is 1,500 ringgit. So you will need to start with, you need to have at least 1,500 ringgit of capital in your trading account. Then, because for most of us at least, when we execute a trade, it will not immediately go in our favor. Sometimes it'll go against us, sometimes it'll stop us out. So you need additional buffer in case the price goes against you. So you need more than 1,500. Okay, so let's say your stop loss is 300 ringgit. Okay, so then the bare minimum you should have as a buffer is slightly more than 300 ringgit. Make sense? Because you get account of things like commission and so on. So as an example, in this particular scenario, the capital that you need to initiate a one contract FCPO Q24, in this case August, right, and U24, in this case September trade is, I would suggest personally, 1,500 ringgit of margin, and you gotta have an additional buffer of more than 300, in this case 500 ringgit. So you gotta have at least around 2,000 ringgit to initiate a calendar spread contract. Okay, so this is, I wouldn't give you like a ballpark number of how much you need in terms of absolute number. I'm going to show you how to, at least a direction or step by step, how to decide the capital size that you need. All right, hopefully this is helpful for those of you who have a question on how much you need to start trading calendar spread. Now, take away from this session is number one, understanding the fundamental of spread and for the instrument that you like to trade. Okay, if you want to get started, right? Learn technical analysis for a more precise trade execution. And obvious or for brokers with a more competitive commission. Email them, ask them, okay? And also all for brokers that allow you to trade spread. When you ask them about commission in the email, ask them also whether you're allowed to trade spread. All right. Ask them also that whether you can trade a certain asset like FCPO or FKLI. Okay. And number four, look for a futures broker that offer you as a client a complete trading platform for charting and price ladder. Okay. So we have come to almost the end of the session for my own presentation. So let me quickly conclude what we have learned today. Number one, a unique feature of futures trading compared to other products like stocks is you can trade as a futures trader, you can trade contract with different expiration month. Okay. Secondly, at its simplest form, spread trading refers to traders speculating on the price difference, right, between two futures contract of different month. Okay. Why trade spread? Why trade spread, right? Because as a whole, generally, spread requires lower margin compared to individual outright futures product. And generally, right, for certain product, they tend to spread, their product tend to have, their underlying spread tend to have display very consistent seasonal pattern, which I've shown you just now in our discussion, right? And how to form trade ideas. Number one, seasonal and fundamental analysis. Number two, technical analysis, and even better, combine all of them so that seasonal and fundamental analysis give you a clear bias or direction on where to trade, and that you use technical analysis for a more precise entry. All right, and of course, I will cover the downside of spread trading is number one, higher commission. Be prepared to pay higher commission when you are trading spread, because at one time, whenever you initiate one calendar spread, you're essentially trading two outright contracts. So it's always commission times two, right? It's always commission times two. And then, unfortunately, there's relatively lack of information about spread trading online. But luckily for us in Malaysia, Bursa has done a great job at accumulating all the knowledge and insights about spread trading over the years. Go to Bursa Academy, Bursa Marketplace, right? There are a lot of different materials there that you can look into, especially if you are very interested with spread trading. Okay. And finally, there's less liquidity when it comes to spread trading, which is something that you just got to accept as a spread trader. Okay, so let me see. Okay, so this is pretty much everything that I want to cover today. Thank you so much, everyone, for being present, and I hope this has been helpful. And I should pass the stage to CY for the Q&A session.